Hey guys, I just wanted to take a minute to tell you about Spotify, where you can listen to all of your favorite artists and podcasts in one place completely free. You do not need a premium account. Spotify has a huge catalog of podcasts on every topic, including this one here with multifamily investing. On Spotify, you can follow your favorite podcasts so you never miss an episode. You can easily share what you're listening to with your friends on social media like Instagram. And premium users can download episodes and listen to offline wherever they are. If you haven't done so already, please be sure to download the Spotify app, search for Starkey Multifamily Podcast, or browse podcasts in the Your Library tab. Also, make sure to follow me so you never miss another episode of Starkey Multifamily Investing. Thank you for tuning in to the Starkey Multifamily Podcast. My name is Reed Starkey, and I have with me Neal Bawa. He is also known as the Mad Scientist of Multifamily. I definitely like that title. He's also known for being the data-driven multifamily guru or expert, I guess we'll say. So I would like to introduce Neal Bawa. Neal, thanks for coming on.
Thanks for having me on the podcast. Very excited to be here, Reed.
Yeah, so Neal, tell us a little bit about how you got started into multifamily, and then we'll tag into some of the bigger stuff you've got going on today.
Sure. Well, a fairly atypical start, right? So a lot of guys that get into real estate, because they're brokers or because they invest in single family, and that definitely didn't happen for me. I'm not part of the typical real estate industry. I'm a technologist. I've had a successful tech career. Worked for a company for 17 years that I was a partner in. Had a successful technology exit. Retired. Found retirement to be the most horrible and boring thing that one can possibly imagine. I don't even. I said retirement is not something to celebrate because your brain starts to melt down the next day, and so that was horrible. So I've had all of that, but I've always been in real estate, and so people ask me how long you've been in real estate, and my answer is, well, that depends on where you start counting, because unlike most people that start with a single family rental, I started with a new construction project in 2003. I was running a tech company. We had hundreds of employees and lots of cash, and we decided to build our own custom campuses as opposed to just renting an existing campus, right? So built our flagship headquarter campus in Fremont, California, the home of Tesla. So that's now the city is famous because Tesla built an even bigger campus, but we built one that was really well known at that point in 2003, 2004, and it really ignited our growth. The campus was actually part of the growth of the company. So 2 years later, I was forced to build an even larger campus and much more expensive campus. And we just put up millions of dollars to build the first one. So we didn't have the cash to buy all of the second one. And so we ended up doing a syndication, an actual real estate syndication. We didn't even know that word. We probably violated every SEC law that ever existed because we didn't even know what we were doing, right? We were not real estate guys. And so we brought in a bunch of people and they all invested their money, and we basically pooled together and basically built this building from scratch. It was 33,000 square feet and a fairly expensive building. And it was really successful for everyone concerned. There were a bunch of doctors that invested in it, and we basically rented their suites back for our business, because that was the purpose of building it. Our business was growing, but we didn't have the money to build the whole thing. So we had them buy shares in the building, and then they rented it back to us. And 12 years later, it's still rented back to our business. So it really worked out for the doctors. Mm-hmm. But it really also worked out for me because one of the doctors fell through and I ended up with one of the suites, and I immediately noticed that my taxable income had gone down a great deal, right? My income was up, but my taxable income was down at the same time. And I was like, woo, what is this, right? And I had this big fat tax salary, so the impact was very substantial because I was paying 50% in taxes, right? I live in Taxifornia, so we get taxed like crazy, so 53% was my tax rate. And now all of a sudden I'm like, oh, I'm paying a lot less in taxes than I thought I would. And it's like, oh, it's this real estate thing. Oh, so I'm making money and paying less in taxes at the same time. This is awesome. Can I do more of this? Yeah. And so I decided to go out and buy 10 single family homes in California, which I still own. Awesome, single family homes. They cash flow like crazy. Then I got overconfident and went to Chicago, and without really understanding the market, bought 10 triplexes there, suffered. 6 months later, I was minus $5,000 a month in cash flow because, half of them were empty and the other half of the tenants were not paying. And so I had this horrible problem which led me to start researching something that I've become, fairly famous for, and that's real estate demographics, the art and science of picking the best cities and neighborhoods in America. And it came out of the intense pain that I had to go through in Chicago. But the story ended well because I learned how to be a tenant marketing expert. Because what I realized is if I wanted to get rid of these properties, I had to lease them up first, and I had to lease them up with paying tenants, not somebody who would pay for a month and then stop paying. So I needed to find a lot of really good tenants, and to do that, I became a tenant marketing expert. I found a bunch of people in the Philippines that helped me, and we generated thousands and thousands and thousands of leads for those triplexes in Chicago and rented them up with great tenants and built a 6-month history and then sold off those properties. And so it all ended well. But during that process of pain is when I came up with the real focus system. And now there's between 5 and 10,000 people a year that study the real focus system to understand how to invest in the best cities and neighborhoods in California. And all of this while I'm doing full-time tech, right? So it was interesting how things just kept rolling. And then I invested in passive syndications and became friends with my syndicators, and they started teaching me a lot of very useful stuff that really helped me with my evolution as a multifamily syndicator. Once again, doing this while I'm running my tech business. So when that business finally was sold in July 2013, I was really ready. I had a big meetup group. I had a fan following. I had people that were looking at all the data analytics stuff that I was doing. And so the transition became fairly seamless at that point. And flash forward 6 years later, we've got a portfolio of over $200 million. We've got about 1,800 investors that are working with us on an active basis, passive investors. About $50 million of their money has been invested, and we're on track to raise $35 million in equity this year. So it's been a sort of a story that sounds like it was very planned, but it was completely unplanned.
Oh yeah, and it worked out great for you, and you're doing some big things. So right now you've got you just closed on something really big.
So I closed on phase one. So it's Race Mill is a $130 million construction project in Provo, Utah, one of my favorite markets in the US, and I've been talking about it for 3 years. So if you're listening to my podcast that I'm appearing on, you've heard about Provo. And so it's in Provo. It's also an opportunity zone project, so it's tax-free. And that particular project is in 4 different phases to reduce the risk. And phase one was a $36.9 million project, and with a maybe $11 million raise. And so we just closed on phase one of that project. So I'm excited because I don't have to put in any work for phase two, because I have a waiting list at this point of 71 investors that want to get into phase two. So phase two can't come soon enough.
That's fantastic. So do you run a separate syndication for each phase then?
Yes, we do not believe in the concept of funds. We believe that blind pool funds basically are not the best service. For investor really should make their own decision on whether they should be investing in something or not. So all of our projects are single purpose funds. And so an investor can choose to invest in phase one of a project and not invest in any of the other phases, or invest separately in 3 other phases and get paid out separately.
When you do it, when you break it up into phases, how do you determine the profit made for phase one as opposed to the profit on phase three?
Well, to some extent, by basically each phase, truing up the other phases. But for the most part, they're separate buildings, right? So phase one is one big multifamily building and a smaller building, and phase two is condos and offices. Phase three is a separate multifamily building. So it's not that hard to separate it out when you're building separate buildings.
Got it. Yeah, that makes sense. So that's fascinating. So I want to get back to your Chicago thing when you talked about learning the different markets, and I want to touch on a few things on evaluating individual markets. But tell me first, when you talk about a market being bad or good, or even you'll see better cap rates out of metro areas. The more you get into the further away from the metro areas, you're going to get better cap rates. Why are those, in your opinion, or are those, in your opinion, not as good of a deal, and why?
Well, I think that the answer is it depends. In 2019, today, many of the tertiary markets are better than secondaries, because I believe that what's happening is that the primaries and the secondary markets are commanding such an insane price premium that that price premium is not worth the benefit that you will get when you hit the next recession. If the next recession lasted for 4 or 5 years, the primaries and the secondaries would have been better choices. If the next recession lasted 9 months, which is the typical duration of a US recession, then it makes sense to have gone to that tertiary. You will suffer more during that next recession in the tertiary. Tertiaries get hit harder. But because you're paying such a massive upfront price premium today for your primaries and secondaries, in my mind, over a 5 to 7 year hold, you're going to come out ahead in the tertiary, right? So all you have to do is to be willing to convince your investors that if a recession starts, be much more conservative. Don't distribute as much cash flow. If you're distributing 8%, drop to 4, and put the rest of the money in a war chest in case something bad happens. Because statistically speaking, it's more likely that bad things will happen in a tertiary market during a recession than in a secondaries. The secondaries and the primaries have more jobs than the tertiary does. So jobs do tend to flee temporarily during a recession. Also, tertiaries recover slower than primaries and secondaries. On balance today, though, my belief is that if I look at 100 primary markets, 100 secondaries, and 100 tertiaries, on average, the tertiaries are going to beat the secondaries and primaries. But there are individual primaries or secondaries that probably are better. So hopefully that answers that question. I know that was a very technical answer.
Well, it was good, and I got a couple follow-ups on that. So first of all, very simple question, but for those that are unfamiliar, tertiary market for primary and secondary, can you give a quick description of each?
Sure. So a primary market is the San Francisco Bay Area, and so it's a big market. It's a primary market. Institutionals love investing in primary markets. They rarely invest in secondaries. A secondary market is Sacramento. Sacramento is about 100 miles from the San Francisco Bay Area. It's still 1 million people, but it's considered by most people to be a secondary market. A tertiary market is a market around the secondary, right? So 50 miles or 60 miles from Sacramento is a market like Yuba City or Chico or Stockton, Modesto. These are all tertiary markets because they're too far from a primary or secondary for people to effectively be commuting there, right? So a tertiary market could be one where you can commute into a secondary, or you're like 100 miles from a primary. So those are tertiary markets at this point in time. So an example of a well-known tertiary market, thanks to all the work that I've been doing, is to my audience is St. George. So if you look at St. George, the closest metro is not Salt Lake City, even though St. George is in Utah. It's actually Las Vegas, and Las Vegas is 2 hours away. Therefore, St. George is a true standalone tertiary.
Okay, so thank you for that. It was a very good description. So one other question I wanted to talk to you about, and this may be a little bit difficult to explain or even answer, but we talked about markets being overheated a little bit before the call. And so there's going to be a delta between maybe the value that a market gives you and the cap rate that the market has determined the value is. So how do you determine, or do you look at that? Do you say, these two markets have the same metrics as far as population growth and economic job growth, et cetera, but one is typically trading at a 6 cap and the other is at a 5 cap. Do you look at that at all?
I used to look at it, and I no longer look at it at all. One of the weird things that happened in 2008 is, so a lot of a lot of professionals that work in real estate know this. There is no real estate cycle. There are roughly 400 real estate cycles in the U.S. because there are 400 named metros or MSAs in the in the U.S. So these 400 metros, they have their own cycles, but unfortunately, in 2008, for the first time in real estate history, all 400 cycles reset. Now, since they've reset, they've gone at different speeds. So some might be considered 9th inning of the ball game, and some might be considered 6th. But there really isn't anything in the 3rd inning of the ball game, right? So the U.S. for the first time has seen cap rates of primaries and secondaries merging, so much so that today a primary and a secondary has almost the same cap rate. So this delta that you're talking about truly doesn't exist. Now, in some ways, it does exist. In Cincinnati today, a typical Class B is 5.5 cap, but it's also 5.5 cap in Phoenix. And I would much rather pay 5.5 caps in Phoenix because Phoenix's demographics are so much better than Cincinnati. that it doesn't make any sense to me that people are paying 5.5 cap in Cincinnati. I wouldn't mind paying 6.5 cap in Cincinnati. But it appears that practically every metro in the US, is at the same cap rate for a certain class, which makes no sense whatsoever.
Right. So is there a way somebody getting into this could say, maybe their home market is Cincinnati and look at it and say, this is too low of a cap for what I'm getting. I'm not getting the same value as I would in Phoenix. Because that's one of the biggest things, which I want to get into in a little bit, is how do you pick a market?
Well, the short answer is you look at the demographics, right? So when I'm saying Phoenix is better than Cincinnati, I'm not saying it because I'm invested in Phoenix. I've never invested in Phoenix, right? I've never invested in Cincinnati either. But in my mind, if you had 10 real estate demographers sitting around a table, and you basically ask them which of the two is substantially better, all 10 of them would immediately tell you Phoenix is substantially better than Cincinnati because they're all using the same metrics, right? So there's 5 basic metrics that appear to be universal that all demographers use, and 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 maybe they have a sixth or a seventh. They've all got their own tweaks, but unquestionably, all demographers use these 5, and that is, and we'll go through them one by one, but here they are quickly: population growth, job growth, home price growth, income growth, and crime reduction. So when you look at these 5, there's no way that Phoenix compares with Cincinnati. It is so far above Cincinnati for all of those metrics that you're not even really comparing to apples to apples. Phoenix should be compared with Orlando, and Cincinnati should be compared with Cleveland. So why are cap rates in Phoenix the same as Cincinnati? I have no idea. I think the only answer I can give you, and I know it's a stupid answer, but might still be true, is there's lots of people that are rich in Cincinnati that don't want to travel to Phoenix.
That's a good answer.
And so what I'm saying is today, doing the whole which markets have better cap rates is a futile exercise. Every market appears to be at 5 cap for Bs and 6 cap for Cs. It's just there, and of course there's really horrible markets that are 7 or 8 caps. But I mean, these are markets where there are 10% unemployment, where the US is at 3%. My question is, why should you even look at those markets? You know what's going to happen to them when you hit a recession, right? They're going to go to 20 or 30% unemployment. So just don't even look at them. They're not worth it.
Right. Well,
at 10 cap, they're not worth it, and you're just getting 1 cap as a bonus, going from 6 to 7.
That's interesting. So, and I've seen you talk plenty about those 5 factors. So I don't know that I want to bore everybody with too many details on them. But do you want to take a few minutes and talk about each one and why that's important?
Sure, I'll do a quick view. Basically, you want to invest in places that have at least one. I'll give you the quick version of this, right? You want to have at least 1% annualized population growth. Google will give you those numbers, and it'll give you a chart, the older number, the newer number. Make sure it's about 1%. Higher is better, right? On the income side, you want to be at about 1.5% annualized growth in income minimum. 2% is much better. On the home price side, you want to make sure that you're at least at 2% annualized home growth. 3% is better. And a lot of great cities, like good cities to invest in, like Phoenix, are at 4% annualized home price growth. Orlando's at close to 5%, right? So it's not hard to hit the home price number. And then on the crime number, you want to go to city-data.com, type in the city's information, scroll down to the crime table. At the bottom, there's a blue bar. Make sure that the number on the right is below 500. So a number below 500 means that your city is doing fairly well on the crime. It's not a very crime heavy city. Memphis is a crime heavy city. St. Louis is a crime heavy city. Oakland, California is a crime heavy city. Unless you're really experienced and you know these cities well, there's lots of great money to be made in Memphis. But if you don't know what you're doing in Memphis specifically, that may not be the best choice for you. Right? So there's people that will do really well with those kinds of assets, but they know exactly what they're doing. So, and then the fifth one is job growth, and that comes from the website departmentofnumbers.com. So that's DEPT of numbers.com/employment/metros. Go to that page. The column on the right is the one you sort, and you'll immediately notice that there is a spectacular difference in job growth between cities. At the very top, cities like Reno, Nevada, St. George, Utah, are at 6% job growth. That's insane. At 6% job growth, you can make every single mistake known to man and still walk away doubling money in 5 years or in 3 years, right?
Mm-hmm.
And then at the bottom of the list are a bunch of cities in Louisiana and Indiana, like Lafayette, Indiana, and Youngstown, Ohio. I can tell you, God would have trouble doubling investor money in 5 years in Youngstown, Ohio, or in Lafayette, Indiana. I mean, it is just incredibly hard.
Yeah, and you've got some, and the reason I tried to make that small is you've got some hour-long videos that are fantastic. Is there one particular you want to share with them that I can put in the comments?
Well, I think that to me, the best way to have access to this information, if you're really into it, and really everyone should be into it, is udemy.com/realfocus. So what I did was people kept asking me to build a course around it. So I finally did. It's a completely free course. It's very, very step by step. It's very detailed, comes with Excel spreadsheets and completely free and doesn't sell or upsell anything. So it's just my give to people based on the pain that I went through in Chicago. It's udemy.com, udemy.com/realfocus. Go there and you'll notice that thousands of people are taking that course at this moment. And also read the reviews. I think it'll open your eyes to what is possible with real estate analytics. I tell people this, Reed. I mean, and I hope you remember that if this is your one takeaway, it's worth it. The least sexy things in life are the most sexy things in life. Because the people that focus on the least sexy things get the most outrageous returns.
Yeah, I think that's a great point, and I know that your video. So how I got turned on to you is I couldn't find anybody that had good resources on how to really dig into a market. You know, they had just a few different things, and they mentioned the 5 points, like you said, but nobody really got into it. And there's a video, and I'm pretty sure it's on your that website you gave me.
Mm-hmm.
That is about an hour long. It's long, and it goes into each section and it talks about them, and it is fascinating. So, you know, we just don't have time for that on this show, but I definitely recommend going there and checking it out.
Yep.
It's wonderful information. So thank you for sharing that.
Mm-hmm.
So as the man of, or the mad scientist of multifamily and the data-driven analyst, so market is very important to you. What are some other high on the list things that are important to you as far as what you look for?
Well, so a lot of people believe that our secret sauce is all this demographic stuff. And it's anything but secret if 10,000 people are taking a course right now, right?
Mm-hmm.
So to me, it's our least secret sauce. It's still part of our sauce. It's very important. But what I consider to be our secret sauce is two things. Number one, we believe that asset management, again, very, very unsexy, is the true secret to success. When I am on Facebook and I see all these young syndicators high-fiving themselves on buying this property and buying that property, and this is in 2019, I encourage them to understand what they've just done by buying a property. So imagine that you're on a boat and you're in the middle of the ocean, right? And what you've done is you've got this anchor and it's got a heavy chain. Now imagine if you've wrapped that chain around your neck and you've thrown the anchor in the water. Now, the day that you purchase that 200 unit property, that's you. That's you. Now, over the next 24 months, you have to make sure the anchor doesn't drag you down because that's the end of your property, right?
Mm-hmm.
But and somehow magically you have to pull that anchor back up, right? And not fall off the boat, right? And you also can't let the anchor go because the anchor is the property. You can't just unwind it around your neck either because that's not going to work, right? So somehow you have to keep it tied around your neck and still hold on to it. That's you. And so the fact that for every 1,000 posts about people excited about buying a property, I cannot find one post about people talking about asset management. It really gets me because all the value that you promised your investors is in your ability to manage that property. In 2019, there are no good deals. There are no great deals. There are only market deals. And everyone is overpaying. Neal Bawa is overpaying for every single freaking property that he buys. Okay?
Mm-hmm.
And the whole, I have access to some magical offsite funnel where we get prices below the market. Everyone that's telling you that is a liar and is white These are all white lies. There is no such thing. Every apartment complex owner in America knows that they've got, the market is on their side. If somebody is not listing it in the marketplace, it's not because he's lazy, it's because he's got something to hide. And you're going to find that out within the first 12 months of wrapping that anchor around your neck. It's actually safer to buy properties that are on the market, because if they have 10 people walking through it, somebody basically finds a problem, they now have a legal binding requirement to disclose it to the others, because somebody found it, right, in due diligence and asked them questions about it. And they're signing a document with you that says that anything that was known to us, we told you.
Yeah.
Right? What they're banking on in offsite, off market, is that you're not going to find it. So bottom line, if you're going to pay market or overpay for a property, then the only way you're going to return money for your investors is to really work hard on asset management. But absolutely nobody appears to discuss that in the syndicated forums. And I think you really need to change your mindset if you're going to be successful. One of the quotes that I'm known for that makes lots of enemies is that I believe that 10% of the syndications that are being sold or pitched in 2019 are going to hit pro forma. 10%, Reed, right? And I think that it's possible that half of them may actually not hit any returns, right? And it's possible that some of those properties could be mine. I mean, I'm not, saying in any way that couldn't happen to me, right? We're trying very hard to game the system by buying in better metros, and then we're trying very hard to do asset management in a completely different, completely revolutionary way that I don't believe anybody else is doing. That still doesn't guarantee to us that we can hit pro forma. And to me, it just seems like this is the multifamily industry may not be in a bubble. It's expensive, but it may not be in a bubble. But I think that the multifamily syndication industry is in a bubble. And a lot of people don't agree with me, but that's my belief.
Yeah, it's hard to disagree with you. I mean, you definitely see a lot of, people that are, that weren't doing it a year ago. I guess that would be me as well. But
well, you're educating yourself, right? So that there's a benefit there. You're listening to comments like this from people every day, and I think that influences you in the right direction.
Yeah, I agree. But I love your point, and I want to get back to the asset management. I've talked about this with a lot of people. As you look at all the training that I have ever seen out there, is all focused on getting a deal, and it stops, and that's it. And then, but you own it for 5 years. You only tried to find it for a few months, or however long it took you to get the first deal. But the syndication, the raising the money, that's all easy in comparison. And then you got this long hold period that nobody talks about. So,
and to be honest, I don't think it's 5 years anymore. I think that 5 years was the past. I think you're going to own this property on average for 6.5 or 7 years, because there's going to be a lot of them that won't hit pro forma, and you're going to struggle with them for years until you get them close to pro forma, and then you still have to get your rent bumps beyond that point. So I think that today's journey is actually longer than most people think. They just the people that are thinking we got out in 3 years, the answer is a whole bunch of people did it, right? Not just you. All ships rising. All ships are not rising anymore.
When you say some of your secret sauces in the management of the property, are there any particulars that stand out that I think that somebody may be able to gain from when they're going into it and they got that anchor around their neck?
Well, I think the first thing is that you've got to understand that this is a very big part of the job, and simply working with a property manager once a week is not enough. So one of the lessons I learned early on is that there simply is no syndicator that I know of that knows how to read financials well enough for the job. And so very early on, I hired a financial controller, and she has meetings independent of me. And she has ripped new a-holes to property managers on things that I could not even see. And she has saved me insane amounts of money and insane amount of grief, not just in terms of money being stolen or money basically being wasted, but also in terms of accounting nightmares where I would have had to pay $50,000 later to somebody to rebuild my accounting correctly. So
Yeah.
the first thing is, unless you are a professional CFO, go find a contract CFO. Please go find one, because otherwise 3 years down the line, you're going to be finding one and overpaying them a great deal to rebuild your financials.
That
Nobody has the skill that's needed.
is fantastic advice. I've never heard anybody give that, so that's new information, which is rare in this world. So I appreciate that.
Mhm. The second thing I want to point out is that, a lot of people believe that it's the property manager's job to manage the property. Our job is to basically just hold their feet to the fire. And that may have been true until about 2018. But today, if you want to double investor money in 5 years, at least that's the ambition that syndicators have. I don't know how many are actually doing it. Then you've got to do more. We believe in a very, and I'll say this in a fairly long way. So here come the quotes. We believe in your face, interventionist, activist asset management, where we look at what the property manager is doing well and we try to stay out of their way. And we look at what they're doing poorly and we take it off their hands. And people are like, no, Neal, the right thing would have been to fire that property manager. But I've fired a bunch of property managers. And what I've found is, if I get a good property manager that's not doing something well, the best thing that I could do is take that piece away from him, because he's good at everything else or most other things.
Mm-hmm.
Right? So I'm done with trying to find that awesome property manager that actually does everything that's in their contract, because I came to the conclusion, and you will come to this conclusion, it might take you years and years of banging your head against the wall, that no perfect property manager exists for one simple reason. They don't get paid enough to do everything that's in their contract. So what they do is they do some of those things some of the times, and then they do some things all the time. The things that they're doing well and doing consistently, don't interfere. Pat them on the back. The things that are doing inconsistently, stop trying to beat the crap out of them, because if they start doing those consistently, they're going to drop something else. Take those over. And that's the model that we've had. I built a team in a US plus Philippines team that basically takes a piece up. And because we're doing that for lots and lots of properties in a centralized call center, it's very efficient.
That's fascinating. Well, those are two golden nuggets for sure.
They're hard. None of these are easy. I mean, a contract CFO is not hard. You've got to find one that knows the real estate. So you can't, start with a CFO that doesn't know real estate. But, places like Upwork.com have lots of great CFOs. But to imagine that you are competent enough to fully understand the financials of a $20 million property is hubris of a ridiculous level.
Yeah, that's fascinating because, they really do. A lot of people would like you to think that they're really as simple. So I assume there's stuff that I'm probably unaware that I don't even know.
I've been doing this a while, and I will pass by a line and see nothing wrong in it. And then Loreta, my CFO, in the same call, will zone on it, find something truly horrible that shocks me,
Mm-hmm.
and then the property manager admits a massive mistake, and I go, there are some jobs where you have to be a specialist, and
Yeah.
accounting is one of them.
And then, maybe another good point is I'm sure that Loreta is not cheap, and a lot of people may be afraid by that. But like you said, she's found you $50,000 mistakes that paid for her a few times over.
Loreta is free, and the reason for that is that at every single property I've ever involved her in, she more than pays for herself. Number one, my property managers are terrified of her, even though she's never nasty.
Mm-hmm.
She's very matter of fact, but they're terrified because they know how quickly she's going to find stuff, right? Plus, the accounting nightmares that I've avoided and potential lawsuits with investors who figure out that I've completely screwed up the accounting also make up for her. So she makes up for herself in many ways. Theft prevention, reduces my overall cost of accounting, prevents future lawsuits. I mean, all of those. Yeah, she's free.
Yeah, that's fantastic. Did you have any more on the asset management?
I think one of the things that I'd like to say is obviously property visits are necessary, but I find that sometimes there's too much of a focus put on them. Like people believe that if they don't go to the property every freaking week, something is going to go wrong. And if once you get to the point where your property manager knows what you want and what they want, there's a good meeting of the minds. I would urge you not to spend too much time on planes. I'd urge you to spend a lot of time in those unsexy documents, in charting everything, right? One of the things is the human mind does charting so much better than numbers. So every time you're looking at a table, turn it into a chart, a graph, right? And look at it over time. How's my physical occupancy doing? How's my economic occupancy doing? How is my retention rate doing over time? How's um, my Google reviews doing over time? When I started out, was it 2 stars? Am I at 2.25 now? Maybe 2.5, maybe 3. You know, that tells you how happy your property manager is keeping your property. Trouble tickets, you got maintenance tickets, right? So if you got 30 maintenance tickets a month and you went and did upgraded a bunch of units and you're still at 30 maintenance tickets a month, what is going on there? Shouldn't your trouble tickets be dropping some if you went out and rehabbed 50 units, right? Are you tracking that? How many units are actually being turned on a weekly basis, a monthly basis, and quarterly basis? What is their overall cost? And then what is your capex budget to actual? I think a lot of people are not looking at this. They're just showing up at the property, and I find that it's actually disruptive. They've got a
Mhm.
job to do. They have to basically run around and follow you instead of selling the damn thing. They're selling the units. So showing up at the property, I think, is without an agenda, without specific action items, is counterproductive.
Yeah, very good point. So we're kind of squeezing in on time, but there's one thing I wanted to get into. The last part was you're known for some of your controversial thoughts on multifamily. Um,
Well, I gave you a few of those, but I'll repeat them. Number one, I think that multifamily syndication is in a bubble. I think that there are a lot of people that have got into this industry. Some of them are very bright. I mean, I see some hot shots like Omar Khan that have gotten in that are phenomenal. But I also see a lot of people that are not getting in with the right mindset. They're getting in to make money from acquisition fees. And any industry that is based on people filling their pockets with acquisition fees is going to suffer. And I believe that the syndication industry is going to create a bad name for itself in the next 5 years. So that's one of my comments. The other one that I gave you is I believe that a vast majority of syndication properties being sold in 2019 are not going to hit pro forma or be anywhere close to pro forma.
yeah. So when you talk about fees, what are your opinions on where fees should be? So how are you structuring them fee-wise, if you don't mind discussing that?
Well, I don't think my fees are low. I'm known to be 70/30 pref. I think it's not the fees that are a problem. I think that syndicators believing that the fees that come in should go to their pocket is a problem.
Mhm.
So my current salary is $1 and healthcare. So my company pays for my healthcare out of the fees. And I like that because I'm more focused on the back end, right? That's really where syndicators make money. Syndicators that have been doing this for 30 or 40 years know that the back end is how you make money. The front end is for you to run your company. It's for the Loretas, the asset managers. It's for the people that basically providing value to your investors every day. And I'm not seeing a lot of groups spending that money.
Fair enough. Yeah, I think that's wonderful.
I actually think that a lot of people are receiving too little fees. There are unnamed gurus, now I'm not going to name them, but they have projects where a team of 4 brand new syndicators is doing a 90-10 split with no acquisition fees. Come the next recession, I believe that the vast majority, if not all of these brand new syndicators will return back to their jobs. And when they do so, absolutely no one is going to be managing that property. So
Yeah.
underpayment of fees is the worst thing that an investor can do.
Yeah, I think there's a good balance there. So you need, if from the passive investor's point of view, you want the syndicator, the sponsor, to be making money. If their sponsor is not making any money, he can be the most ethical person alive. But inside of his head, he's going, why am I putting all this work and making zero? So there has to be a balance there where everybody's making money, everybody's happy and moving forward. So that's maybe one of the most difficult balances to find, because everybody wants a lot of money up front, but if it's not balanced, then nobody wants to play.
Yep. I agree, but I really stay away. As a passive investor, I've invested in, I think, 16 syndications myself. And one of my red flags is a syndication that has no fees up front, unless it's some company that's, worth $1 billion and they don't need the money. If there's no fees up front and it's a very light resume, I stay very far away. I don't care if they're projecting double your money in 2 years. It's not something that I'm interested in.
Interesting. Well, it's good to know. So Neal, thanks for coming out. You got some amazing knowledge there, and I had to kind of cut some topics short to hit everything, but I'm glad we got through it, and I certainly appreciate your time. We loved having you on there. So how can somebody get a hold of you if they need to?
Well, I think better than getting a hold of me is to kind of look at some of the stuff that we put together. So for the general public, we've put together more than 25 knowledge webinars, and our library is increasing all the time. These are all deep dive webinars. They're all free. They're at multifamilyu.com, Multifamily University. So multifamilyu.com. And that's really the best place to start interaction with us. If you're looking for training on how to find the best cities and neighborhoods, go to Udemy, udemy.com/realfocus. That's another way to connect with us. I'm very available to people, and so you can just add the word Neal, Neal, in front of that multifamilyu.com and send emails to me if you like. And I don't promise that I'll respond, but probably will.
Awesome. Well, thanks so much. I appreciate every bit of it, and I wish you the best of luck moving forward.
Thanks so much. Thanks for having me on the show, Reed.
All right.
Bye-bye.